Hi everyone, Marshall here. Today, I want to talk about how actively managed funds work. This is a great topic, and I want to go into some detail about how they work. Managers of actively managed funds attempt to beat the market by picking and choosing among specific investments. These investments can be stocks or bonds, and in some cases, they could be alternatives like real estate or commodities or other things. Managers employing an indexing strategy, on the other hand, simply try to mimic the returns of a specific index by buying and holding all the securities in that index. Actively managed stock funds feature in-depth analysis of securities by the fund managers. An actively managed stock fund also gives you the chance to earn higher than average market returns. Higher than market returns. This is the reason active funds are still popular. An active manager offers the opportunity, very important, the opportunity to beat the market. An index is designed to match the market, to actually be the market. And so when you buy an index, you're receiving the average of all the stocks within that index, not anything higher, not anything lower. It provides nothing above average, but you never receive anything below average. So that is why active funds are still popular. Whatever a fund's objectives, managers of active stock funds can use several techniques to try to beat the market. One is to be a great stock picker. Typically, this is done by either a top-down approach or a bottom-up approach. Top-down managers start by looking at the economic trends of the entire economy to help them predict which industries will prosper in the future. Once they identify promising industries, they look within them to find the best companies. Bottom-up managers looking for outstanding company in any industry, assuming that a great company will do well even in an industry that's not thriving at the moment. On the other hand, managers of active bond funds are a lot like managers of active stock funds, and they must sift through the bond market to find the bonds that offer the best opportunity to produce positive returns. Managers of active bond funds must consider other factors. They can try to beat the bond market by careful analysis of a bond's creditworthiness or anticipating changes in an interest rate and anticipating those changes in the portfolio they manage. Bond prices tend to move in the opposite direction of interest rate. Prices on shorter term bonds are less sensitive to interest rate changes than those of longer term bonds. So a fund manager who expects interest rates to rise will buy shorter term bonds, right? And so if a manager expects interest rates to drop, will buy longer term bonds, right? So for active bond or stock manager, it is not easy to pick winners, not easy at all. Active managers offer the opportunity for higher returns, but finding a manager that can identify successful stocks and bonds, let alone pick the securities that will perform well consistently, can be a very, very difficult proposition. When considering an active fund over an index fund, the most important thing to consider is the cost, okay? The true value of an active manager is the manager's talent and competitive cost. It's important for managers of active funds implement a sound investment strategy and not lose too much potential return to costs, such as management fees, transaction fees. Costs are a critical factor in determining fund performance. In fact, the underperformance of an active fund relative to its benchmark can often be the result of higher cost rather than the inability of a manager to pick a winner in their fund. Too often costs are overcost. Investment costs can add up over time. And so when evaluating an active manager, ask these three questions to ask to understand how an active manager's number one. How much experience does the manager have? As with any profession, experience counts. Number two, what is the management's investment philosophy? And do they consistently follow that philosophy? And number three, and what is the manager's track record? Look for the managers whose funds have outperformed their benchmark over the long term. So I hope that helps. So we've gone through a lot of material in a short amount of time here, but today, how active funds work was an important topic. So I hope this is helpful for you, and I will look to talk to you again soon. Thanks so much. Bye for now.